The Great AI Bubble. Your money is trapped in a feedback loop. What we are witnessing in the financial markets is not just a trend. It is a fundamental reorganization of capital on a scale rarely seen, and its implications touch every single person with a retirement account or a passive investment fund. The AI revolution is no longer a speculative future, is the dominant narrative driving the entire market. And your money is already on the line, whether you consciously invested in it or not. The unprecedented concentration of power. The story begins with a concentration of economic power that eclipses even the dot-com era. The S&P 500, the benchmark for the entire US stock market and the bedrock of most index funds, is now shockingly tight. Approximately 40 cents of every dollar you invest in an S&P 500 index fund flows into just 10 companies. The leaders of this new oligarchy are the AI titans, Nvidia, Microsoft, Apple, Google, and Amazon. Nvidia's ascent is particularly staggering. A company that was once primarily known to gamers is now the engine of the AI world, capturing around 8 cents of every single invested dollar in the index. To put their spending into perspective, these companies are projected to pour over $330 billion this year alone into building the physical infrastructure of AI data centers and GPU farms, a figure that rivals the GDP of a medium-sized European nation. The trillion-dollar reality gap. This explosive growth, however, has created a dangerous chasm between current valuations and current reality. For today's stock prices to be justified by traditional financial metrics, these AI giants would collectively need to generate an estimated $2 trillion in annual revenue. To understand how monumental that figure is, it is more than the combined annual revenue of Apple, Amazon, Microsoft, Google, Meta, and Nvidia today. The market is quite literally pricing in a future of near-infinite profitability. This disconnect was laid bare when OpenAI Sam Altman casually discussed a $1.4 trillion spending plan to achieve artificial general intelligence (AGI). When pressed on the financial viability, how a company with roughly $20 billion in revenue could possibly fund such an endeavor, he deflected the question. Later, he half-joked that the US government might need to act as the insurer of last resort. To seasoned market observers, this wasn't a joke. It was a signal. It hinted at a potential too-big-to-fail dynamic in the making, where the sheer scale of private sector bets could eventually necessitate a public bailout to prevent systemic collapse. The self-licking ice cream cone, how the bubble inflated. Beneath the surface of impressive growth charts lies a circular and potentially precarious financial loop. Imagine this: Nvidia, flush with profit from selling its AI chips, invests billions of dollars directly into AI startups and developers like OpenAI. OpenAI uses this capital to pay massive bills for cloud computing power from providers like Microsoft and Oracle. Microsoft and Oracle, in turn, take this revenue and place colossal new orders for more NVIDIA GPUs to expand their data center capacity. This drives NVIDIA's profits and stock price even higher, allowing it to make even more strategic investments, and the cycle repeats. From a distance, every company in this loop appears to be experiencing phenomenal organic growth. But a closer look reveals that the same capital is often just circulating within a closed ecosystem. This activity is frequently financed by debt or off-balance sheet financing, masking the true risk. It's a virtuous cycle on the way up, but it could become a vicious vortex on the way down. The systemic risk to Main Street investors, the natural response might be, let the speculators lose their money. But this misses the core of the danger. Because these AI-driven companies now constitute such a massive portion of the S&P 500. They have become unavoidable for passive investment vehicles. Every Vanguard, Fidelity, and BlackRock index fund is legally obligated to mirror the index. So, as the valuations of NVIDIA and Microsoft rise, these funds must automatically funnel more retirement savings from millions of ordinary people into them. This creates a powerful feedback loop. Rising prices force more buying, which pushes prices even higher. Completely detached from the underlying company's actual profits or revenue growth. The market is, in effect, pumping itself up. The canaries in the coal mine, while the crowd chases the AI rally. Some of the most renowned figures in finance are sending stark warnings. Warren Buffett's company, Berkshire Hathaway, is sitting on a record-breaking cash pile of over $180 billion. Buffett is famously cautious when he cannot find value, and his current stance signals he sees the market as overvalued and ripe for a correction. More pointedly, Michael Burry, the investor who famously foresaw the 2008 housing collapse, has placed significant bearish bets against NVIDIA. These are not isolated incidents. They are signals from two very different schools of thought converging on the same conclusion. The market is priced for a perfect AI-driven future that may never materialize. The hype is so potent that it may even be distorting the broader economy. Analysts at Deutsche Bank have suggested a provocative thought experiment. If you stripped out the massive stimulative effect of a irrelated capital expenditure, the US economy might already be in a recession. The AI boom is not just a part of the economy. In many ways, it is currently propping it up. The inevitable reckoning, the fundamental question, is no longer about the transformative potential of AI that is real. The question is one of timing, scale, and financial discipline. How many years will it take for these companies to generate the trillions of dollars in real, sustainable profit that the market is already assuming? What happens if the adoption of AI products is slower or less profitable than expected? What breaks when the cost of capital rises and the cheap money fueling this boom dries up? The longer the hype cycle continues and the more the feedback loop inflates prices, the greater the eventual correction will be. The bubble isn't just in a few tech stocks. It's woven into the fabric of the entire market through passive investing. When the loop finally breaks, the consequences will extend far beyond Silicon Valley boardrooms and into the retirement accounts of millions.